All right. Good afternoon, everyone. Welcome to our Bright Talks for this month entitled Market Wrap Up and Key Themes for 2024. My name is Selay Aguila from SlamC Agency Team, and I will be your host and moderator for today. So, this afternoon, we will have a recap of what happened in 2023 in the markets, its highs and lows, and what we can look forward to in 2024. So before we start, just want to get a feel of our audience. I hope everyone can participate. Let's have a poll question there. So how are you feeling about your investment portfolio today compared to last year? So first option there. First option, I'm still on the negative territory. My investments are down. So here medyo you're kind of feeling despondent pa, no? Second option, same, but different, meaning you have already started to rebalance and now waiting on how it will pan out. So, meaning for this second question, so you have already started to make some movements on your investment portfolio. And last option is that, you're anxious, but you're hopeful on what 2024 has to offer. So, some optimism here. Sige, let's keep the votes coming. Okay. All right. Thank you for your answers. I am ending the poll now. Thank you for your answers. Okay, so the answers that yielded most is you are still on the negative Tory, but your investments are down. So let's try to answer and address that feeling no, later. Okay, so let's move on. Inflation and interest rates are some of the most used terms for this year. You know? So how did it affect the markets or how did it affect your investments? So let's try to look back at what happened this year. So let's start with the local markets. So on your screens, flash now is the movement of the PSEI side by side with the local inflation trend. So on your right is the PSEI and on the left, baligtad, sorry. On your left is the PSEI, on the right is your Philippines inflation. So on inflation, pinahin na natin doon. One thing that we've observed is that it peaked start of the year. It rapidly went down, and there were some surprises, but nevertheless, it continued a downward trend. But how come on your left, diba? How come despite the improving inflation numbers, our PSEI has been going down? The pandemic is over. PSEI is supposed to go up, but it went otherwise. Like this morning, the market closed, I think, 6,300 level. Diba? Next slide, please. Okay, for the global markets, if in 2020 and in 2021 we had the FANG stocks, this year the Magnificent Seven have been on top of mind on many investors. Apple, Microsoft, Amazon, Google, Nvidia, Tesla, and Meta or Facebook. These names are the names that make up the Magnificent Seven, and they are the largest US-based companies by market cap. So the Magnificent Seven make up 28% of the S&P 500 index. And in a research by Goldman Sachs, as of October, the Magnificent Seven stocks have gained 71%, while the other 493 have added just 6%. Another item being magnified this year is the increased interest in income-paying funds. Next slide, please. There. So this is from Public's June platform survey, no, where it surveyed the most prioritized investment strategies for second half 2023. This was answered by 1,005 respondents. And what we can get here is that participation in the public markets remains high, and more significantly, it is evolving. Retail investors are diversifying across asset classes and strategies. And by far, the most popular strategy for retail investors is dividend investing, with 50% of the respondents selecting it as something that they're interested in. Well, this is because of the high interest rates that we have right now, diba? And this just shows that dividend investing have become a priority. The hype on AI or artificial intelligence is also there, which is tied with the total stock market index investing at 26%. So if we tie it or if we marry it with our earlier poll, we can infer that investors are entering the remainder of 2023 with some confidence despite mixed feelings about the state of the economy. So this afternoon, we hope to shed some light on that and take a glimpse of what 2024 has to offer. As this is our last Bright Talks for the year, we are privileged to be joined by three speakers this afternoon, and later we will have a chance to talk to each one of them to ask questions. So these are our speakers for this afternoon, starting off with one of our regulars, Mr. Pat Ella, our economist. For the fixed income sleeve, another crowd favorite, Chelsea Lim. And for local equities, it will be discussed by Luigi from our equity research desk. So let's start first with Pat, then Chelsea and Luigi. I'll come back later for Q&A. Hi Pat, take it away.
Hi. Hello. Thank you. And excited to see the new year, what will happen. So, this is a look back and at the same time an outlook for domestic. Then I'll move on to the global portion. Okay. Next slide, please. Okay. Key themes for at least for the domestic. Uh, I'll keep it simple. I don't want to put in a lot of things here. I just want to focus on what will likely drive markets next year. So first and foremost, rate cuts are coming, and there's a tentative expectation that central banks, at least the major central banks, are planning rate cuts. Definitely, the Fed is expected to definitely pause, then get into the rate cut maybe by the mid year next year, or probably mid second quarter at the earliest. And it also means that the BSP is also positioned to do rate cuts, as we will see later on. This also has to do with the favorable, or we're at least entering a favorable inflation environment after a year or even 2 years of challenging inflation. Second point, inflation has peaked and is returning to normal. But make no mistake about it, there's still some supply problems, both domestic and globally. El Nino is still a problem Asia-wide after 4 straight years of La Nina. Uh, so there's supply problems related to the weather, but also domestically. We also have to bear in mind that Asian Asian flu that affected the meat industry in late 2021, 2022 is still around, even in trace amounts. So that is definitely still affecting supply. But as for rice, it's definitely normalizing. The harvests are coming in quite well, and we are likely to see stable rice prices going forward. Also, the dollar peso, 54, 55 is likely the range that we will see. Entering 2022, entering the current administration, the twin deficit story has been a worry, but it really never materialized, to be honest. Uh, Government fiscal spending is actually somewhat a little bit surprised. The government was able to shore up the fiscal balance, and the current account balance, because of global weakness. There is less pressure on the current account to widen, and therefore the peso is a bit stronger. 6% GDP, yes. To be honest, back in second quarter when the numbers came out for GDP, I was really not optimistic. I even put GDP at sub 5%. But government was able to uh, keep its promise to scale. I mean, ramp up its spending in third quarter. And so I think there we are seeing a floor of 5% in terms of GDP at worst. But 6% for next year is a clear case driven by consumption. Then oil prices are coming back to reality. They're coming back to fundamentals after a short bout of geopolitical scare. Okay, next slide. So we'll start with our forecast. So CPI inflation 6.2%. I think we're right on track to hit that, and 3.8 next year. My view of inflation is a bit more optimistic than the market. BSP is at 4.4, and I think that it will still go down to at 4%. As I said earlier, we are really seeing normalization of the inflation factors we have seen that was plaguing 2021 and 2022 and this year. For GDP growth, uh, 2024 should be 6%. I have to correct that. That's a typo. So 5.6 this year, 6% next year. Consumption is very resilient. Although food spending has more or less flattened out, but non-food spending is still growing between 7 to 9%, right? And the very fact that you see a lot of activities, online shopping and all that, just underscores the fact that food, the consumption has a very strong base. The worry is uh, private private investments, which is really being impacted by the high rates. Again, dollar peso fairly stable. 53 for next year. To be honest, it's quite a bit optimistic on my part, but I think there's a lot of normalization we are seeing in terms of the inflation premium that we are seeing. So without inflation next year, or at least the volatility of inflation, we will likely see a more stable range in 2024. For BSP, I expect them to cut at least 100 basis points next year, starting in second or late second quarter, or sometime second half. Um, I think there's a case to be made for inflation. Once inflation hits the 4%, I think there's a very strong case for the BSP to start a rate cutting cycle. And personally, I think the BSP is really primed to cut rates because they're already seeing the impact on GDP of high interest rates. Like I said, capital outlays or private investments are being really slowing down. Okay. And for the Fed, market's looking at 2 to 3 rate cuts. I think it's fairly reasonable to expect that. Um, but the question is, how long will the Fed pause, and how soon they can start cutting rates? Okay, next slide, please. Okay, for GDP this year, the changes are just in terms of consumption. I'm fairly confident 5% is the worst case scenario even for next year. Government spending, that's the challenge. Infra spending has really been slower than expected, and that's the challenge for next year. Uh, despite fears of a twin deficit, meaning one of those twin deficits is a fiscal deficit, the government has really shored up and showed some marginal improvements there. Then private investments. This is the part where once rate cuts come, this could likely see upside here. Because as you have seen, 2021, 22, we had double-digit growth here. The only reason why it's single-digit growth this year is because interest rates really has hampered capital outlays. And so that's why my GDP for this year is 5.6, and on a similar basis, 6% for next year, accounting for some technical considerations on growth, but largely uh, between 5.6 to 6% is likely growth scenario for this year and next. Next slide, please. Okay. Inflation, basically, the expectation here, it's really normalizing. I expect 2 to 4% target of the BSP inflation target to be reached. And I think it will come in first quarter next year. Oil also has a lot to do with this expectation. I mean, we're at $80 a barrel. 2 months ago, it was at 90. Again, I never really bought into the geopolitical scare that we have seen because of the Hamas, I'm sorry, Israel Hamas conflict. Uh, Oil market has shown that it's going back to fundamentals, and also domestic supply considerations are also showing an improvement in inflation. So we're looking at 6.2% this year and 3.8% next year. Next slide. Okay, for the dollar peso. In the chart here, I just wanted to put, whenever the peso uh, depreciates by double digits, which is the red, those cells in red. Typically, the years after that, we had a very stable dollar peso between 1 to 4% depreciation. And it's also the same thing what we are seeing now. Very mild strengthening, in fact. We're seeing 1% growth year to date. But since September, the peso has been strengthening, but more like closer to 3%. So going forward, 53 to 55, that range, or 54 to 55, is a reasonable range. And if you go to the next slide, we see, our forecasts are more optimistic than the market. The Bloomberg consensus is the dotted gray line, and it's ranging from 56 to around 54. We are more or less at the more optimistic 53 to 54 ranges. That's because I think, once we don't see any more inflation pressures, I think the peso has some room to appreciate, right? Okay, so that's why our forecast for 2024 is around 53.5, or roughly 54, and same thing for 2025. Next slide, please. For the BSP, again, our model suggests 100 basis point rate cuts at least next year. GDP is clearly being impacted, as I've said earlier, by investments, and the BSP is really conscious of this. That's why they have been steady in their rate pause, and I think they will also continue the rate pause for next month's last meeting for the year. So, yeah, so for bond investors, this should be good news coming into 2024. Next slide, please. Yes, oil market. As you have seen, forward price and the median forecasts for 2025 to 2027 really is on a downward trend, right? And that's why the triple digit oil price, I never really believed in a triple digit oil price scenario. Once the market gets back to the fundamentals, weak global demand, it will really see a downward trend in oil price forecasts. So our view is $80 to $83 per barrel for 2024. Next slide, please. Okay, this is just a chart of more of our forecast for other economic variables. If you can get a copy of this, please feel free to, if you have any questions, happy to answer them later. Okay, next slide, please. Right, I think we go into the global markets. Okay, so for global markets, okay, inflation has peaked, but for most markets, it's definitely elevated. Even for us, we're at 14-year highs in terms of inflation. Monetary policy is definitely tight, but is expected um, to becoming slightly loose for most central banks. Geopolitical tensions definitely hurt the risk appetite, and we have seen this. There's some hesitancy into global markets since the conflict we have seen in Israel. But that tends to be short-lived if you look at the history of geopolitical conflicts, their impact on equity markets. Now, money markets, to be honest, has been the most popular product globally, and this simply tells you that there's a lot of excess liquidity waiting to be deployed. However, point number five is also another thing to consider. Soft landing scenario or hard landing scenario are more. I am more into the camp of soft landing, and I have even as far back as 2019, fourth quarter 2019, I was already saying U.S. might get into a very mild recession, but of course, COVID took over, and we had a severe contraction in the global economy. But the soft landing story is something that has been around. Uh, will the U.S. enter a soft landing or a hard landing or a recession? Again, a recession can take many forms. For me, I think it's going to be a recession, but a very soft recession. And lastly, equity returns. Definitely, as you have seen earlier in the earlier slide cell I showed, it's really concentrated on the Magnificent Seven, or the upper part of the large capitalization in U.S. equity. But apart from that, I think equity returns are in the single digits for the rest of the market outside the Magnificent Seven. Okay, next slide, please. Okay, this is what I'm saying. If you look at the market cap, the chart in the left and the right side, the top three tech companies occupy lion's share of the market cap, and compare that to the three largest markets in Europe, right? It doesn't. It's both a probably we can call this the eighth wonder of the world, but really all of these market returns are driven by a very small handful of stocks, especially in the United States. And that's why if you look at returns of the ACWI, MSCI ACWI All Country World Index, you can really separate it into US versus the rest of the world. Then in the US portion is just the top 10 tech stocks in the last 20 years versus the rest of the US market. Okay, next slide, please. Okay, in terms of growth, you see here a divergence, right? While the world is poised to grow to 2.8 to 3%, US just under 2%, but Asia is disproportionately biased towards 5 to 6%, right? Philippines is perhaps the second strongest growing region after India. We should be growing at 6 to 7% the next few years. But interestingly, global inflation is seen to more or less converge. While the Philippines, we're looking at 3.8%, the rest of the developed world is a point below, 2.3 to 4%, right? So while growth forecasts are diverging, global inflation forecasts are really converging, and that says a lot as to the state of central banks. Again, that's why I'm fairly optimistic for not only a rate cut next year, but also for bond investors, because I think the handwriting is clear. Inflation is going down, or at least stabilizing. Therefore, rate cuts are coming. Next slide, please. Okay. As I've said, money markets has been the most popular product. However, this has also put a tailspin, or not necessarily tailspin, but it has also put challenges into the equity risk premium. At least the premium we price into equity products, because in order to separate it from opportunities in the bond market. It is suppressed, definitely suppressed. Also explained by weak growth, weak domestic growth, and by high inflation. But again, once we see a lowering of inflation, I I'm pretty sure that we will see some of this equity risk premium reflect itself in the U.S. market. But for me, the big question is how will the market take a recession, right? Because the last recession we have seen, it's globally induced, meaning because of COVID, we have to shut down. But this time around, this is a naturally forming recession. How will markets respond? To be honest, I'm still at a loss at how equity markets will respond. Perhaps the US will continue to be the outperformer, right? Next slide, please. Okay. In terms of earnings outlook, I think it's still favorable across the world. I mean, Philippines, we're still what 20% this year, roughly. Next year, I think it's 9 to 10%. Again, Luigi will give us more color on that. But for multiples, as you see in the right slide, in the right side slide, most of the upper end of the multiples globally is really US, is the US market, the US tech, US small cap, and US large cap. Um, so US definitely at a premium, but will that premium disappear next year? I don't think so. I think US still has a leadership position. And to be honest, if you look at again, if you look at MSCI country world, most of the drivers of the growth in uh, the ACWI index is really from US from the US source, from the US equity market. But definitely growth will be a premium and has continued to be a premium. Value, again, in a in a in an environment where rates are being cut, will value suddenly emerge? I'm less convinced of that. I'm more convinced of growth, right? Because US is still pumping out despite expectation of a soft landing. It's still generating growth. Okay, next slide, please. Okay, tailwinds for next year. Again, the tricky part here is that policy rate cuts need not always translate to strong market returns, right? As you've seen there, between February 89 and June 89, most of the markets really didn't rally. And that's because you had the Gulf War, right? Or at least the few months entering into potential Gulf War that eventually happened in 1990. Also, markets didn't rally in May 2000 and 2001 because you had a global correction in tech stocks, right? So it really depends on the economic environment that we are facing. And currently, I think it's more favorable than previous years because again, inflation is receding at different rates, and therefore a policy cut will likely follow. But whether markets in general will rally, it's not clear cut. But I'm more certain that U.S. markets will be at the pole position because again, you have growth, and you have the only equity market that has really been growing for the past few years. And bear in mind, the U.S. market has been growing this even during COVID, right? It has. We see strong bounce in the S&P even during COVID. Okay, next slide, please. Okay, in these four charts, I like to highlight the bottom right chart. Okay, So this is a survey of will there be soft or hard landing? Most are looking at a soft landing, 74%, while hard landing purists are still hoping, 1 out of 5 people are still saying they're looking at the hard landing. But, recessions can take different forms. You can have the Great Recession post GFC, where it was a really challenging market and the recovery was very long, more than 6 years. Or you had a swift recession just after the first Gulf War, 3 quarters of global contraction. But really, for me, because we had COVID, because we had a swift contraction, then bounce back, I think the next phase of a recession will be really mild. So I'm definitely more in the soft landing or mild recession camp. I've yet to be convinced of a severe landing. But the only thing that will likely, for me, change my mind is if the commercial real estate segment in the US will be as worse as the mortgage market meltdown we saw in 2008. But unlike mortgage market where the underlying asset has no income, commercial real estate has income because it's rentals, it's leases, right? So that is something that investors have to look out for. Next slide, please. Okay. Geopolitical events. I like the fact that uh, Jake included this in this chart. For all of the hype or scare that people impute into geopolitical risks, it's really not a long-term play. It is really not a long-term determinant of returns. So as you see here, Falkland Islands War, Cuban Missile Crisis, Iraq War, everything bounced back within 12 months. Okay. Uh, Although no two events are exactly alike, that's true, but long-term returns eventually are driven by fundamentals. So at the end of the day, geopolitical risks are really buying opportunities. Next slide. I think this is the last slide, right? Okay. So where we're headed, growth would decelerate modestly while inflation continues downward trajectory. And I think we will see inflation slowing down first, rather before any global growth deceleration or contraction. Central banks are poised for easing. Geopolitical tensions, exciting, very sexy for the headlines, but really, to be honest, it's best kept at the background. Lower yields provide support for long duration, fixed income, and for equities. And finally, dispersion of returns to continue to be wide. Yeah, definitely, the Magnificent Seven will continue because these are like, for me, they're more utilities than anything else because uh, from telephone to cell phones, from desktop to tablets, these are really essentials. So they will likely continue leading the market, but there's definitely going to be a dispersion of returns, meaning a wider set of returns for anything other than the Magnificent Seven. Okay, hoping to answer your questions later on, and I'll give it back to Selai. Thank you.
All right, thank you, Pat, for that very comprehensive discussion. We will have our key takeaways later, but for the meantime, I will pass it on to Chelsea to discuss the fixed income sleeve. Hi, Chelsea. Yeah, maybe you can unmute there. Thank you, Chelsea.
Okay. Hi, good afternoon, everyone. I'm Chelsea. Allow me to walk you through our 2024 outlook for fixed income. So my simple message this afternoon is that bonds remain attractive. We think that investing in fixed income funds will continue to benefit your investment portfolios in 2024. And there are three main reasons why. First, in terms of the macro backdrop, inflation is moderate. Second, rates are still trading at historically attractive levels. And lastly, for portfolio diversification. So a quick recap on what happened this year. It has been quite an eventful year for fixed income markets. We saw central banks continue to hike rates during the first half, but eventually they slowed down the pace of hikes as inflation. So on the table here, you can see what the Fed and the BSP did over the course of the year. So inflation peaking is a good sign as it meant that rate hikes are doing their job. So in the Philippines, inflation peaked early this year above 8%. So this allowed the BSP to pause multiple times during the second half of the year or June onwards. So at the moment, real yields are already positive. This means that policy rate is already higher than inflation. So for the Philippines, policy rate is currently at 6.5%, while the latest inflation print is at 4.9%. So with inflation moderating, how has uh, the market performed? The 10-year Philippine government bond yield is lower by around 100 basis points or 1% year to date. So for context, there is an inverse relationship between interest rate and bond price. Lower rates translate to higher bond prices, which is what we want for our portfolios. So in the US, it's the same story. Inflation has moderated and real yields are now positive. We've seen the 10-year US Treasury yield peak at 5%. Nonetheless, despite the recent moves, rates are still at historically attractive levels. To illustrate, we have here the historical chart of the 10-year peso interest rate and 10-year US interest rate. For peso, the 10-year rate is trading above 6%, while for the US, it is above 4%. So if you will look closely, you will observe that we are currently at the higher end of the historical range. So buying a bond fund now allows you to lock in yields at these elevated levels and position your portfolios to benefit from any potential move lower in yields. So how are we thinking about where yields will go in 2024? Right now, inflation is trending lower, but still above target. For the US Fed, their target is 2%. For the BSP, the target is for inflation to fall back within the 2% to 4% range. While inflation remains above target, central banks are sticking to the higher for longer narrative. They're looking to keep interest rates elevated for quite a while. Now, for 2024, as Pat shared his forecasts earlier, we think that inflation will already fall back to within the central bank's target. On the other hand, economic growth will be weaker than expected. Our in-house model shows a 47% probability of a US recession. So with weaker growth and inflation falling back to target, we think that rate cuts will likely happen next year. But the timing and magnitude of these rate cuts remain highly uncertain. Currently, market is pricing in 2 to 4 rate cuts for 2024. The pricing of rate cuts move depending on economic data and central bank communication. For us in Slim PC, we are looking at about 4 rate cuts during the second half of 2024. And this could be a catalyst for yields to move lower. So what are the risks to our view? So these are scenarios that could delay the timeline of rate cuts or dampen investor appetite for bonds. So in the US, if economic growth continues to show resilience and inflation remains sticky and stays above 2%, the Fed will have to stick to their higher for longer stance and delay rate cuts. So in the Philippines, the threat of El Nino during the first half of 2024 could push inflation higher. And then also we're seeing that the uh, to fund the 2024 budget of the national government, there is the risk of increased bond supply. So now for my last point on why bonds remain attractive. Uh, investing in bonds, investing in bonds or fixed income will allow you to diversify your portfolio's risks and returns. So, for example, looking at the historical performance of um, local equities and fixed income, we can see that it's mixed. Some years equities perform better, while other years fixed income perform better. So for 2024 specifically, we think that bonds offer decent accrual at current levels, and bond prices could also benefit from capital appreciation once rate cuts are in place. So just to summarize some of the points I made earlier, in the macro front, inflation has moderated enough for central banks to pause and keep rates steady. But the timing and magnitude of rate cuts remain uncertain as inflation is still above target. And lastly, the higher for longer interest rate regime could lead to increased market volatility, not only for fixed income but also for equities. Thus, diversification is key. So that's it for fixed income. I'd welcome any questions later. Thank you.
All right. Thank you, Chelsea. So what we've gathered there is 2024 will be a year of rate cuts, and in-house view is 2 to 4 rate cuts for 2024, second half. Okay. Thanks, Chelsea. We will call you back later for our Q&A. At this time, we will now call Luigi to give our outlook for the local markets. Hi, Luigi.
Hi, Salai. Hello, everyone. Good afternoon. I'll try to make this quick, given our time constraint. I hope I'm clear. Anyway, let's proceed. First slide. Yeah. So obviously, the market has equities market has disappointed quite a bit, right? This was when I did these slides, it was returning -5% on a year-to-date basis. It had rallied a little bit since then, and it's now doing -4% on a year-to-date basis. So, are there chances of a late rally? Well, we did see some strength in the past couple of days, right? Following following the BSP's decision to keep rates on hold, and also in the last meeting, and also the sense that um, rates are peaking and inflation is starting to turn, right? So that's why it had rallied in the past 5 days. What about next year? We believe it will be a tale of two halves, with the first half kind of mirroring what's going on now, and the second half doing much better, given the likelihood of significant easing by both the Fed and the BSP. Um, so that is the main bright spot, I guess you could say. But in addition to that, we always count on good earnings growth from the various sectors that make up the PSE, and also probably better execution on the part of government next year, to really maximize the contributions from the private sector. What when I think about what investors are waiting for, um, it's pretty clear, no, that it hasn't changed since the last bright talks. It's still liquidity, market catalysts, right? And stability of the FX rate, which has really been the main drag. Can we move to the next slide, please? Yeah, so as you can see, there is an inverse correlation between the market and the exchange rate, right? And if you look at the left chart and towards the end of that, you could see that the market is beginning to recover somewhat, and the FX rate is the peso is beginning to strengthen. So it's definitely moving in the right direction, and these are really pricing in uh the, I guess, sentiment that we are at peak rates already, and we take our lead from the Fed, and it shows in it. And although they are still data dependent and cautious, given the expectations of a soft economic landing, whether that be a short and shallow recession or some other form, um, rate cuts are also on the table there, and that translates to more room, policy room for us to ease as well. Um, on a year-to-date basis, as of the 24th, right, November 24th, the net foreign outflow had reached already 862 million US dollars. And year-to-date average foreign participation in the market is 46%. It improved a bit. Um, and turnover remains very low in the fourth quarter. You could see in the bottom chart that the average is 110 million US dollars, and that really fell October and November. So, when the market's illiquid, because there are, net foreign flows are negative, that means that whatever trading is happening there, especially if it's on the sell side, exacerbates the decline of the market and individual stocks, obviously. So that really explains why the poor performance of the market. Um, and there are different reasons why foreign flows are staying away. Like I said, there's various macro storm clouds have gathered, right? It started with the inflation that um, crossed over into 2023 from the outbreak of the war in 2022. That tended to be more commodity driven, energy particularly, and some soft commodities. And then you had the scare with the bank closures in the US, kind of linked to the tech sector. And then you had another relapse of inflation was coming down. Then you had a relapse in the middle of the year, sort of right after the second half began. And then you had the 2Q GDP disappointing also. And then you had the Israeli Hamas war, right? So I mean, these all which contributed to fear that oil prices would go up. And so whenever that happens, right, the peso is kind of under pressure. Not to mention the hawkish trajectory of hawkish, I mean upward trajectory of Fed rates really pressures the FX, our FX rate. So from the point of view of a foreign investor, you have negative currency carry, meaning even if you were to earn at best whatever 5% um 5% uh, price return on the market, if the currency depreciated by, well, it's actually flat, right? But let's say depreciated 2 or 3%, then your return is cut in half, right? That's why they're not coming in, and so there's no liquidity, and if there's no liquidity, us locals who keep trading the market, if sentiment is poor, it's bad. We're bearish or we're pessimistic on the market. whenever we sell, it's only worse. It brings the stock prices in the market, the whole index price lower than it usually would if liquidity was good. Can we go to the next slide, please? Um, so we can't really blame it on earnings, right? Because you could see that most of the index constituents are pulling their weight, right? Bloom recently entered the market, the index, right? After Metro Pacific, Aboitiz Power, and Union Bank left the index, Bloom entered along with CNPF. Um, and you could see that there's a high base effect because in 1Q, 2Q last year, the casino was still closed, Soler. So now that it opened this year, it looks like earnings are so strong, but Bloom is just a small weight in the index. And then if you look at mining, that's really Chamirara, right? And because of the dramatic fall in coal prices, earnings were really low. So these are the outliers, right? But if you look at everything else, the ones with big representation in the index, like the banks, and the property companies and the conglomerates, easily 70%, right, of the index or so, they're doing quite well. And other names like PLDT Globe and ICTSI are really just flat, not really showing any earnings growth at all. But the market as a whole, we're expecting it to do 13% year-on-year growth this year, and next year about 8.4% growth. So therefore, whatever interest the foreigners have in our market, go there. So as you can see, banks is the favorite, but ICTSI, which is a global company and is really quite defensive, even if you're looking at a downturn in, like, again, a soft landing in the US and other countries. Valuations are good, and also it's expected to be resilient. That's why inflows are flowing into banks, ICTSI, and property also. Property used to be negative, but now with the malls doing so well, and even the residential segment booking more gains, having more launches, cancellations are falling. They're starting to enter property as well. Okay, can we move to the next slide, please? But our market kasi competes, right, with other equity bourses worldwide. And the favorite really has been technology. All this fascination right now and interest with artificial intelligence has really caused names like the Nasdaq to rally, as well as North Asia, right? North Asian markets. Can we move on, please? Next slide. So that said, we're really cheap right now, trading at 11 times future earnings per share, or EPS. So the bottom left hand slide just shows, right, that since the pandemic, earnings per share for the whole market is on a steady upward trend, a significant upward trend every year. Um, and yet the market continues to trade at a discount relative to where it should be. Okay, so in the past, like let's say the last 15 years, you would pay about 15.5 pesos to own a share that paid you back 1 peso in earnings, right? But now you're only paying 11, right? And the what you get in terms of earnings per share is just expected to keep increasing given the good execution on the part of the private sector. So we know that the problem isn't with the corporate performance. In fact, as of the third quarter, as you can see, about more than 90%, more than 80% of companies were either in line with expectations or ahead. Kind of the same also with consensus. Okay, so can we move forward one slide? One more, please. Yeah. So um, it's really the macro, right? And what signs are there that show that things might change? Well, if you look at inflation relative to the policy rate on the upper left hand slide, you'll see that inflation really has been the leading indicator, meaning it happens first before policy rates move. So the yellow line, as you can see, if it goes up, after a while, the blue line also goes up. And when it goes down, after a while, the blue line also goes down. So on the very right hand side, you can see that last inflation print was only 4.9. It really did peak, as Chelsea said, in January at 8.3, I think, or something. And then so it's just a matter of time before the blue line also comes down. And when the blue line comes down, meaning the policy rate comes down, um, people get more optimistic on the economy because the cost of borrowing is lower. People will borrow from the banks and invest instead of saving their money. Okay, and therefore economic growth will expand, right? And therefore corporate earnings will also expand when that happens. That's why, reward wise, it's looking better in the future compared to now. But it does not seem like investors are ready to buy, invest everything right now, because again, the valuation of the market is still very low. In fact, it's two standard deviations below the 15.5 multiple that I was talking about earlier. So that means that something else has to happen, right? Something else has to happen to catalyze that recovery. Then, as you can see also in the bottom left-hand chart, um, the market, which is in blue, tends to do well when the currency is stable. It doesn't mean it's flat. It means that the peso can be on an upward trend relative to the dollar, meaning over time, very gradually, the peso is weakening, but it's not volatile. The market can still do well. But when you see in the kind of the right side of the chart, when it's very erratic, the movement of the FX rate, the market really um, uh, mirrors that volatility, right? And because of that instability, foreigners stay away. And you could see that the percentage of not just the PSEI but the whole all shares has fallen in terms of what foreigners own from 10 years ago till now. Next slide, please. So, as I said, we continue to see growth in corporate earnings. In fact, when we looked at our bottom-up fundamental target prices for the 30 index names, we came up with a valuation of over 8,000. But of course, we will not realize that anytime soon, and we have to discount that because, as I said, the currency has to be stable. You need specific concrete catalysts, and you need better liquidity because, as I said, you know, better liquidity is a precondition for foreign flows to enter the market, right? And also to reduce volatility, which is also what foreign investors want to see. Um, okay, so can we move down, please? So right now we apply a discount. Um, we believe that the market only deserves to trade at one standard deviation below the long-term mean, which is 12.8 times. And if we apply that to our 2024 index target, our target for next year is 7,206, which is 14% upside from now. And this is about 8% lower than the street average or consensus average of 7,850, which is about 24% upside from where we are now. Okay, for this year though, we're maintaining our base case of roughly 7,000, given that it's too close to the end of the year to change it. And we acknowledge that it's not realistic that it'll get hit. So it may be closer to the 6,400 worst case scenario level that we have. Next slide, please. Yeah, as I said, we hope that rates will ease in the second half. Um, but we're not really seeing any reason why the prerequisites I talked about will improve. That's the downside risk. Next slide, please. Next slide, please. Yeah, I think I more or less covered this already. the interest rate differential has historically been 1 point. So if we're at 6.5, if the Fed's at 5.5, then we're good at 6.5%. But if we allow that to widen, like above 1 point, then that's not typically a good sign, and the market can get penalized for that. So the BSP has to choose between maintaining that, defending the peso through the policy rates, or promoting growth, right? Because high borrowing rates is bad for growth, as obviously. Can we move on, please? Next slide. As you can see, on a year-to-date basis, average daily turnover in the market is only 110 million US dollars, below the long-term average. So this has to come up, but I already explained why some foreigners are hesitant. Next slide, please. So what would be a compelling catalyst? Well, I think better execution from the government. I think this year was all about establishing certain tools and marketing the country abroad. It's basically really the first term of the new administration, the first year of the term of the new administration, to do all of these things. And hopefully next year will be about execution and implementation of the I guess the staging or the preparation phase that happened this year. Next slide, please. Yeah, so earnings, we continue to be positive on corporate earnings. We believe that inflation really has peaked January at 8.7, sorry, not 8.3, 8.7%. And therefore, local rates have also likely peaked. Um, since foreign inflows are so low, what hopefully there's nowhere to go but up, right? In the near future. We don't really believe China is in a position to benefit us, given that um, uh, they disappointed expectations of a rebound this year, and expectations for next year are even lower. Yeah, so the things that we're used to hearing, inflation, geopolitical risk, yeah, it's still valid. These are valid risks in the near term, and we just have to see how these might abate. But all signs are pointing towards that direction, that inflation is moderating, and hopefully a ceasefire, a permanent solution to the problem in the Middle East will come soon. I think that's the last slide, right? Yeah, okay, thank you. Let me know if you have questions.
All right. Thank you so much for that, Luigi. Okay, so before I call back our speakers for our Q&A, here are some key takeaways. So these bullets basically sums up what our speakers have discussed. So first one is rate cuts to be anticipated for next year, led by the Fed. BSP is positioned to cut rates possibly earlier. Number two, consumption is seen to recover while global growth would decelerate modestly as inflation slows. So ito yung kanina na na-mention ni Pat, we can expect to see inflation slowing down first before any growth deceleration. Next point is central banks would be more open to policy adjustments to achieve soft landing. Geopolitical tensions ease but remain in the risk. Again, as Pat mentioned, best to keep it in the background. And lastly, positive sentiment to weigh in on the markets on easing policy rates and improving inflation. Nevertheless, local markets need a strong catalyst to sustain trajectory on the upside. All right, so I'm sure you have a lot of questions and clarifications on our speaker's discussion. So they are already here. Okay, mag-Q&A na tayo. First question, this is for Pat. Let's start first with the macro question. Pat, for local and global markets, what would be the key themes for 2024?
Well, I think the one that we've been repeating all throughout, it's because they disproportionately impact assets. It's definitely a rate cut, right? I think that's already a big portion of what we can expect. But the one that we have to figure out is how much will they cut, and will it be throughout the year, or would it start half at the second half? And second is inflation, um, how fast or slow it will moderate. And third, uh, this recession that's being expected, will it finally happen, or will it come in fast or slow? Again, these things are expected, but how they will be executed is an entirely different question.
All right. Thank you, Pat. So that's rate cuts, inflation, and the expected recession.
Mm.
Okay. Still with you, Pat. Next question. Asia accounts for 4.5% growth for 2023. How much does Philippines contribute to that? And what would it take for the Philippines to be the direct inflow of foreign direct investments?
Uh, 4.5% GDP growth, yes, but being one of mid-tier in terms of GDP weight. Of course, Asia x Japan, right? It's outside of Japan. We're probably 10% of global. I mean, of the Asian region, if you combine the nominal GDPs. So we're more or less coming up the ranks in terms of Asia. Um, but if we rank our GDP growth, I think we're one of the top, uh, second to India, perhaps, and Vietnam, right? We're 6-7%. We've been doing that quite easily for the past decade. So, second part is, what would it take for Philippines to be the direct recipient of FDI? You know, one of the biggest determinants of foreign direct investments is really foreign ownership, right? There's so many long-term studies been done by ADB, by World Bank. Is, will the rule of law apply to investors, and can investors have ownership? The reason why you have seen Vietnam, Hong Kong, Singapore have very high rates of FDI is because they retain ownership. Problem is, here in the Philippines, we still have barriers to entry in some industries. We still have barriers to entry owning land for foreigners. But if those can be relaxed or adjusted, we will definitely see huge inflow of FDI. It really boils down to updating our laws. But yeah, FDI is really tied to private ownership of foreigners.
All right. Thank you, Pat. So let's try to zoom in on our local markets. This one is for Luigi. Luigi, what do you think are the major, next slide, please, there. What do you think are the major catalysts that could help regain the confidence in Philippine markets? Well, you've already mentioned earlier better execution and implementation from the government. Are there anything else?
No, I think this late in the year, certain infrastructure projects, particularly air infrastructure, like the flagship NAIA rehabilitation. I think that's a huge project that I believe the deadline for submitting the bids is December 27, right? So whoever wins that, right, must fund it. Um, and so I think that that would be a significant economic driver if it's smooth sailing and everything goes well next year. And I think the mechanism for the government to shore up its share of public-private partnership has also been enhanced, right, by the Sovereign Wealth Fund. And I think all of the vacant positions, like for example, for a while the Agriculture Department didn't have its own head, right? It was the president, but now that has already been filled. And I think certain policies that didn't work perfectly, uh, they learned from that, particularly in agriculture, and that could help contain rice prices next year. So yeah, I think uh these there's signs of better execution next year, which will complement the good execution already from private companies. All that's left is that, rates have to come down so that the projects make economic sense. And then once that happens, everything is shovel ready and the projects just take off. And then there's a multiplier effect to the whole economy.
Okay, thanks, Luigi. Well, earlier you mentioned our 2024 forecast for the PSEI is looking at 7,206. Do we already have an indication of average broker forecast for PSEI 2024?
Yeah. As of mid-November, it's 7848. So we're about 8% below that.
7848 for the average broker forecast for 2024. Right.
Yes,
All right.
7848.
Yeah. Thank you, Luigi. Let's now go to fixed income. This one is for Chelsea. Chelsea, markets are pricing in a Fed rate cut by June 2024. Do we believe that BSP will follow?
Yes, so usually, I think someone mentioned the interest rate differential earlier. So if BSP cuts the interest rates, then the BSP will have room to cut interest rates as well. So it would also depend on the local inflation situation. Like I said, there's the threat of El Nino during the first half. So we have to see how that will pan out. But if we continue to see inflation sustainably go down to within the BSP target of 2% to 4%, then there's no reason for them not to follow if if the Fed will indeed cut rates by second half next
All right. Thank you, Chelsea. Actually, in the year that was, no, sorry, given the anticipated rate cuts by central banks next year, the outlook on the bond markets is very rosy. So, what's your strategy for our bond fund, if it's something we can share? And if we can already share our bond fund outlook for 2024?
So currently we still do not have our return forecast yet. No? So we'll probably release that later in the year, closer to year end. No? But as mentioned earlier, there's two sources for fixed income returns for 2024. First is accrual, which is the interest rate that the coupons you get by investing in fixed income. That alone is uh, quite attractive right now. As I mentioned, peso bonds are yielding above 6% at the moment. So the capital appreciation coming from possible rate cuts is could be a rate or an additional bonus source of return for our investors. So the strategy there would be, just as I said, to continue investing in fixed income funds because that will allow your investment portfolios to benefit from the potential rate cuts that will come next year.
Okay, so load up on bond funds for next year. All right, thank you. So, Pat, going to global markets, in the year that was, the global bond market was challenged. Do we think that 2024 will be a year for global bonds? And maybe I can already marry this with our next question. For global equities, well, in 2023, global equities have greatly recovered from 2022 losses. Do we think that global equities can sustain the rally in 2024?
Okay.
Yes.
Going first to the global bonds, because we're expecting rate cuts or at least easier central bank conditions. So yes, I think global bonds should have a turnaround in terms of their performance after 18 months of really punishing interest rate hikes. For the all country world, um, it's hard to pin a number, but a range of 5 to 6%. I think that's a reasonable return in the past decade. Easily, if you look at their averages, 5 to 6% return is well within a reasonable expectation for all country world, especially in a decreasing interest rate environment. That should be good for equities.
All right. Thank you, Pat. Next slide, please. Yeah, maybe we can already skip this. Pat has dwelled
Yep.
on that. Yes, Pat was
Ah.
already able to discuss that earlier. Okay, for the last question, markets have been saying that U.S. recession is inevitable, but we haven't
Mhm.
seen it. Is a
Mhm.
U.S. soft landing a key catalyst for next year? By the way, for benefit of audience, soft landing here refers to a moderate economic slowdown following a period of growth. And the
Yeah.
Fed and other central banks aim for a soft landing when they raise interest rates to curb inflation. Yeah.
Yeah.
Yes.
Yeah. The recession story has been around, I think, for more than a year now, because you know the yield curve inverted, meaning the short end 3 month rates are higher than the long end, which is the 10 year, and it's still inverted.
Pat, sorry, you're on mute
Sorry,
there.
sorry.
No
Yeah.
problem.
So the recession story has been around for quite some time because of the yield curve inverting sometime mid 2022, meaning the short end, like the 3 month rate, is higher than the 10 year rate. Uh, that always signals a U.S. recession eventually occurring down the road. I do expect I'm between a soft landing and a soft recession, a mild recession. So yes, I think we're slowly seeing signs of a softening U.S. Economic growth. I mean, jobs the last 4 months, jobs has been going below their market expectation after a period of being slightly above market expectation, meaning it's the actual job numbers is actually uh, coming below the market consensus. So that shows you, steadily weakening environment on the U.S. On US GDP. So yes, I think in the next 6 months or 2 quarters, we should see softening conditions in the U.S. But like I said earlier, for me, the biggest risk in the U.S. is commercial real estate, because uh, much like the mortgage GFC, situation, you're seeing an overinvestment in the commercial real estate side, and at the same time, you are seeing a lot of people not, uh, you know, like Airbnbs. A lot of Airbnbs are closing down. A lot of office spaces are still vacant in the U.S. So it definitely hits the profitability of these commercial real estate. For me, that's a big risk. But if that can be avoided, we will likely see a very at least a mild recession scenario.
All
Okay.
right. Thank you so much, Pat.
Yep.
To our speakers, Pat, Chelsea, and Luigi. Thank you so much. So, next slide, please. All right. In the interest of time, we will now wrap up our session. So we have here a slide that summarizes the key themes for 2024, and for each theme, we have identified some of the funds that you may consider adding to your portfolio. So these three themes tells us a story. Because inflation is going down, this will allow central banks to safely lower interest rates, which would allow growth for economies again. And with lower interest rates, banks are able to lend more, corporates can borrow cheaper, allowing economies to expand, which would translate to better and improved earnings. So there you have it, our 2023 recap and key themes for 2024. Before we end, just some reminders. Next slide, please. We'd like to mention again the newest addition to Sun Life Prosperity family of funds, our income paying fund, the Sun Life Prosperity World Income Fund. Next slide, please. The World Income Fund offers you monthly payout directly credited to your bank account. And this answers the question earlier. It will be directly credited to your bank account monthly. There's World Income Fund also offers potential capital growth with the fund's exposure to global markets while denominated in Philippine pesos with very affordable initial investment amount required at 10,000 pesos only. Next slide, please. Okay, we are also implementing the enrollment of settlement bank account for credit to account transactions. SBA or settlement bank account is your nominated bank account where your fund redemptions and other proceeds will be credited to. On your right are the acceptable proof of bank accounts that you may submit when enrolling your SBA. And last but not the least, we would like to plug in again our client promo. Next slide there. Thank you. We would like to plug in again our client promo, the 2023 Invest for Rewards. Yes, invest and be rewarded. For a minimum of 1 million pesos in fresh funds, subscribe directly to any of the participating funds. You will get 6,000 pesos gift away EGC. Full mechanics of the promo is uploaded in our website, or you may reach out to your financial advisor. Promo runs from September 20 to December 29. So that is it for our webinar for this afternoon. We're very sorry for the overtime. Thank you again to our speakers, Pat, Luigi, and Chelsea. Thank you again for tuning in, everyone. Again, my name is Selai, and this event has been brought to you by Sun Life Asset Management. Stay safe and happy holidays!